Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about money mistakes of middle-income Americans. This was an article done by Fox Business. Very good article. A lot of what's in there are things that we talk to our clients about. Not just investments, not just saving money, not just retirement planning, but also things that you can do to help you with debt situations too. But the first one we're going to talk about, because we see it a lot, is not making more than the minimum payment on your credit card. When we sit down with people that come in our office to find out if they'd like to work with us and we'd like to work with them, we go through a scenario where we look at their investments, we look at their risk, their time horizon, whether they want to use the money for retirement or for their beneficiaries or their heirs. We also look at debt situations. And we're constantly telling people that one of the main goals when you're planning for retirement is to use your 50s to reduce debt significantly. And part of the reason is if you don't meet your financial goals for retirement income, you need to reduce debt. It's very easy. Either increase income or reduce debt is going to make a more favorable situation and a better financial plan. Well, if you're going to retire, it's hard to make more income because you're no longer going to be working. So therefore, your investments need to stand on their own 2 feet. They need to grow and outpace inflation and hopefully outpace some of your withdrawals. But on the debt side, many times if you can take care of that mortgage is going to be a main factor with having a more comfortable retirement. But the one that comes into play too is it would be school loan debt and also credit cards. And many times the credit card is more in control. You can take care of some of those things. So we like to recommend paying down that credit card. Most importantly, paying more than the minimum on the credit card. Tyler, what else should we talk about when we're talking about not making the minimum payments on credit cards?
Yeah, so when it comes to money mistakes of middle-income Americans, the article that we're referencing, we see a lot of these just with different people that we deal with on a daily basis. And when it comes to not making more than the minimum payment on credit cards, there's actually a survey done by an investment firm, Primerica, and they surveyed 1,000 middle-income Americans and found that 1 in 3 middle-income Americans say that credit card debt is their biggest financial concern. And that's really a problem to us because in today's day and age that we live in right now, there's so many people that they don't think twice about putting a purchase on their credit card and going into debt to fund something. And then it starts a snowball effect where that builds up over time. They accrue a debt balance and they can never pay it off then. So again, with 1 in 3 middle-income Americans saying that credit card debt's their biggest financial concern, that's a really big problem. And people use credit cards to supplement their income, and when they do that, you have a potential to rack up large debt that way.
Okay, Tyler, you bring up a good point. I mean, the word you use is supplement. People use credit cards to supplement their income. A credit card is not an income source. It's a convenience. A credit card allows you to put, you can go purchase something conveniently so you can go back and then pay for it. Do not use a credit card to supplement your income. Do not use it as a source of income.
Exactly, and that's where people really make their biggest mistake is they feel they don't have the necessary income through work, through their job, so they use a credit card as a source of income, and really all they're doing is racking up debt, so it's really the opposite. Now, if you do use a credit card, obviously make sure to make a full payment each month and keep the debt balance off the card. Now, we recommend using credit cards or keeping credit card use to a minimum in general, but if you do decide to use one, and if you have to use one, because I know there plenty of people have credit cards, you definitely want to keep that debt balance off them because we've seen it too many times where you have a card and you use it, and all of a sudden you do get that debt balance, and you don't think a big deal of it, and then over time you accumulate a debt balance, and then before you know it, you might have anywhere from $10,000 to $50,000 of credit card debt, which is what I've seen just over the last couple months. Now, if you do have, again, if you have gotten yourself into that situation, if you do have credit card debt, then only making the minimum payment is a mistake. And we see that oftentimes where people do have a large amount of credit card debt and they're only making the minimum payment. They're paying a very high interest rate on that. So what you want to do is you want to come up with a payment plan to pay off credit cards as soon as you can. And there's really two ways to go about it. And these two ways, they work for things outside of credit cards. So they could work for auto loans, student loans, for a number of different debts that you might have. But one is called the debt snowball, and that's actually Dave Ramsey's method that we like, where you pay off the smallest balance first. So you list all the credit card debt balances. I've seen a number of times where people might have 5 to even 10 different credit cards. And if that's the case that you're in and you have a debt balance on every single one of those, what you might want to do is list them from the smallest balance to the largest. And it's called a debt snowball, where you do as much as you can toward the smallest balance, get that knocked out, you gain momentum and go right on down the line, and then eventually you knock out the largest balance, and then you no longer have that credit card debt. Or the other method is the interest rate method, where this one makes more sense mathematically, but it doesn't necessarily give people the momentum as the debt snowball method. But that's where you take the one that has the largest interest rate, regardless of what the balance is. Start with the largest rate, pay off that one first, and then go right on down the line. And again, mathematically, you're going to come out ahead that way if you use that one. But really, either one works. The main thing is getting a payment plan so that you can get that paid off as soon as you can. Limit credit card use. But if you do use one, then just make sure to pay it in full each and every month, so that way you don't accrue a debt balance on it.
Okay, one other thing here, Tyler. The situation comes up when we talk to some people about their credit card debt and ask them why they have such credit card debt. And if it's health related, they run into some issues like that. I guess I can understand that, and you're going to have to work with it. But when it comes down to making purchases, the one I hear and quite frankly doesn't hold a lot of water is, I purchased product XYZ because it was on sale. It was a good purchase. I needed to get it now. So you ask them, what was the discount? Well, the discount was 10% or something, so it was a good purchase. Only to find out that they don't pay off the credit card balance the following month, and then they're paying 12% interest. So your 10% discount just became a 12% premium. So, really scrutinize the credit card. Also, we try to sway people to using debit cards more often than a credit card. Sometimes it's just a habit to grab a card and put a purchase on there. Look at a debit card. Basically, if you don't have money in the bank to cover it, you can't buy anything. I mean, it's that easy. So credit card balances, try to reduce them at all costs. Okay, the next thing they were talking about in this article was not having enough coverage in life insurance, and that's basically $50,000 is sort of the threshold they were looking at. And when it comes to life insurance, we deal with life insurance here in the office too, because it's part of the planning for retirement. And people just typically don't like to really have extended conversations about life insurance. They don't believe that it's part of a financial plan. They would rather talk about investments, stocks, bonds, and mutual funds. Yes, they're more fun to talk about, but really one of the most efficient parts of a retirement plan is life insurance. And part of the reason is, with retirement comes age, and we get older, okay? And as we get older, there's probably more need to have some of that life insurance in place. The problem you run into is if you wait until your retirement years to get life insurance coverage, typically you're going to pay more in a premium. Why? Because these life insurance companies think you are closer towards death, so therefore they're going to charge you more of a premium. But one of the reasons, and Tyler's going to talk a little bit more about this, but one of the reasons I like to see it in place, even when people say, well, I really have no reason for life insurance, all of the things that you usually look at to determine whether you should have insurance, I've taken care of. One thing they tend to forget about is long-term care. And right now, there are a lot of life insurance companies that have an element of long-term care. It doesn't take care of it completely, but it really helps offset it. It's called accelerated death benefits. So if you're looking to get a life insurance policy, make sure you ask your agent if they're accelerated death benefits. What that means is the death benefit is accelerated to pay out while you're living should you have a critical illness, go into nursing home, need hospice, things like that. And basically it can be utilized for those expenses so your spouse isn't left having to use investment money to take care of your needs, and then of course you pass away. So Tyler, what else should we talk about with not having more than $50,000 in life insurance coverage?
Yeah, Dean. So again, another money mistake for middle-income Americans in the article said not having more than $50,000 in life insurance coverage. And they determined that many working families have an average of a $50,000 death benefit in life insurance coverage. So really what they found out is that many people underestimate how much they need. And to begin the conversation, it really starts with, okay, well, how much do you need? And it's dependent upon what you need life insurance for. And there's really three basic needs, three basic triggering effects for you to need life insurance. Number one would be dependents who rely on you. So if you're in your working years, you have kids who are, in elementary school, middle school, high school, even in college, you have dependents who rely on you. That would require life insurance. If you were to pass away, you want to make sure that they're taken care of, that they have a death benefit that the surviving spouse can use for them. In addition to that, if there's one spouse that's a higher earning spouse, they earn discernibly more than the other, you want to make sure that the spouse who's not earning as much is still covered as well. So that way, if anything happens to either one, the other one will have a life insurance death benefit to help them out. And then lastly, if you have any form of debt or a mortgage, you want to make sure that your spouse is covered or your beneficiaries are covered. So that way, if you do pass away, their debt situation is taken care of for them. So again, if you have dependents who rely on you, if you're a higher earning spouse, or if you have any form of debt or a mortgage, those are all reasons to have life insurance coverage. And it's really a general rule of thumb to have about 10 times your income in death benefit. And that's where people tend to fail and underestimate how much they need, because 10 times that basically makes sure that you're covered if you were to pass away, and the other spouse can replace your income and different things like that. But again, that amount can vary based on one's individual situation. It could be less than that, could be more than that. But general rule of thumb is right around 10 times your income and death benefit. And then you also need to determine the length of the policy. So again, there's 10, 15, 20, 30-year terms. Of course, we're big believers in cheap term policies, but you want to determine the length of the term. Now, usually when people are younger, it's recommended to get that 30-year term. You want to get the coverage while you can, while you're still younger and you're still healthier. But again, one of the main mistakes is not having enough life insurance. And as you said, Dean, life insurance, it's an important part of any financial plan, and it needs to be accounted for. We see it too often where it's not.
Good points, Tyler. Okay, before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, we're going to talk about the next topic, and this one is not having money invested in accounts outside of traditional savings. We see this quite often where as people get closer towards retirement, they do one of two things, which we consider both of them mistakes, and that is they either get too safe, money goes into savings or CDs, something where they feel more comfortable based on market volatility, but unfortunately it doesn't keep up with inflation in 5, 6, 7 years from the time that they put it into these safe havens. Unfortunately, they don't have the returns that they're looking for, and then they need to make decisions to move it outside of that. The other mistake is just the opposite, and that is for those people who really don't have enough money to retire, they just feel uncomfortable that they just don't have enough. They try to get very risky with their investments, hoping that they can make significant gains as that last hurrah before they end their payroll. Both are mistakes. But the trend of just putting money into savings and not investing, many times it's just a misconception of how much money you need to invest. Tyler, talk about some of the basics in how much money you need to invest outside of your savings.
Yeah, good point there, Dean, because many of these families, they mistakenly believe that they don't have enough to invest outside of their traditional savings accounts, when really that's very hard to believe, because you can invest in mutual funds within a Roth IRA, for example, for as little as $25 a month. Now, again, you might be in a situation where you are really hurting and you can't do that, but for many people, setting aside $25 a month to invest shouldn't be too hard to do. And then as your financial conditions improve, you can then increase that amount to $50, $100, $200 per month, etc., and work your way on up. But really, there's mutual fund companies out there where, again, $25 is the minimum that you need to invest per month, and a lot of people can do that. Now, over time, that really adds up, and if your investments are held within a Roth IRA, then they're completely tax-free in retirement, and we really do like Roth IRAs. A Roth IRA is a type of investment account where you put the money in from checking, savings, after-tax dollars that you already pay taxes on, and then anything that you put into the Roth account plus any of the growth is tax-free in retirement. And we're really pushing for Roth IRAs right now because tax rates are lower. They're probably only going to increase in the future. So you want to put money into a Roth IRA, pay taxes on it now at a lower rate than when your tax bracket might be higher later, when you might be in a higher tax bracket, or when tax rates in general are higher, then you're taking the money out completely tax-free at that time. So Roth accounts, we really like those, and you can start with as little as $25, $50, $100 per month into a Roth account. But first you want to pay off the credit cards like we talked before, pay off student loans, auto loans, pay off your debts, build up an emergency fund, which we're going to talk about that next, and then try and aim for 15% of your income invested in various retirement accounts outside of your savings. So I see people who are in their 20s, 30s, 40s, 50s, 60s, all throughout the spectrum that have substantial money in savings, but they don't have enough invested in retirement accounts. And we'd like to see you aim for 15% of your income invested in various retirement accounts. And that would be like your 401k through work. The first place that we tell people is your 401k up to the match. Now, if you have a match, it's free money, so you're going to want to invest right away into your 401k up to the match. Then we like to see you go outside of that to the Roth accounts where they're tax-free. And then if you max those out, then you can go back into the 401k and continue to put money into there as well to try and hit that 15%. Many employers are offering a Roth 401k now, and if your employer does offer that and they have relatively good investment options within there, then we'd like to see you go right into the Roth 401k, because you can put up to $19,000 into the Roth 401k, and if you're 50 or older, that bumps up to $25,000 that you can put per year into the Roth 401k. So right now, the IRS, they allow you to put a good chunk into a Roth 401k if your company offers it. So you really want to take advantage of that. But you can invest as little as, again, $50 or $25 per month in mutual funds. And that's a big mistake that we see middle income Americans making, is not having money invested in accounts outside of traditional savings. So if you don't, you're going to want to look to do that, because over the long term, you stand to accumulate wealth greater in investment accounts, mutual funds, stocks, bonds, as opposed to just keeping it in savings.
Okay, the next mistake we're going to talk about for middle Americans is not having enough savings to cover at least 3 months of living expenses. This is a big one, and unfortunately, this is one that we tend to see linked to credit card debt. And part of the reason is if you don't have enough cash built up and in savings to take care of your emergencies, you typically put it on a credit card. And then unfortunately, that credit card bill doesn't get paid the next month, and then it continues to linger on. So many times when we talk to people about their debt situation, when we're putting together a financial plan, it seems to be with credit cards, when you talk to them, okay, again, some people might put convenience purchases on there. Like I talked earlier, something was on sale. It's no longer a sale because you don't pay it off the next month. Therefore, you're paying a premium for the product instead of on sale. But then outside of health issues, it comes down to just emergencies. Something happens where let's say the furnace goes out, or there's a leak in the roof, or something with your home. Yes, you need to put it on a credit card at that particular time because somebody's coming and needs payment right away. But then you need to dip into your emergency funds that take care of your expenses to pay for that bill. So, Tyler, talk about the basics we want to see. And again, this is a big one, not having at least 3 months of living expenses set aside.
Yeah, so by having those at least 3 months of living expenses, that emergency fund, you won't have to go into debt and put unexpected expenses on a credit card. And that's a big mistake that we see a lot of people make, where they never take the time to build up that emergency fund, that 3 months of living expenses. So what they do is they run into some sort of unexpected expense, whether it be their car breaking down, they need a new car, a new roof, health expenses, whatever the case might be. It could be a number of different things. If they don't have that emergency fund built up, then they right away put it on a credit card, and all of a sudden they're in debt $5, $10, $15, $20,000, and they're not able to pay that off because they don't have anything in cash. They don't have a savings position to do so. So that brings them back to the first mistake of middle-income Americans, which would be the credit card debt. So in order to not have to worry about that, you want to have that 3 months of living expenses built up. And many middle-income Americans, they tend to neglect an emergency fund in general, and they go right into debt, which again isn't ideal at all. So that 3+ months of living expenses in savings, it allows for you to pay the bills if you were to go through a job loss or any type of income loss in the short term. And it's recommended to have at least 3, but some people feel more comfortable with a whole year's worth, so 12. Some people more so at 6. So 3 is kind of the minimum number, but it all depends on where you're at. There's some people that, again, 12 months they feel better, some people at 6. All depends on what you feel comfortable with, but generally 3 is the minimum. 3 months of living expenses minimum in your savings that you keep there, and you don't go under that number in case you need it as an emergency fund. And in order to get there, you might want to start by setting aside a fixed percentage of your paycheck until you get to 3+ months of living expenses in your savings. So that might be 2 or 3, 4, 5% of each paycheck you want to set aside in that savings account until you build it up to about 3 months of living expenses. So that way you know that you have that number there and you can use that. And what might happen is when you're working to do that, when you're setting aside that amount each paycheck into your savings account, you might have to dip into it for various unexpected expenses. And you're taking 2 steps forward and 1 step back, but at the very least, you're not going into credit card debt to do so. So again, you want to work that up, see if you can get 3 months of living expenses in your savings. And the whole goal with that is to have money set aside for these emergencies and for these different unexpected expenses that pop up, where you don't have to use a credit card, you don't have to go into debt to pay for it, and just as bad, you don't have to dip into your investments or retirement accounts, because we've seen that as well, where retirement accounts, you have to be 59 and a half or older to access your 401k, your IRA, your Roth IRA, or your whole Roth IRA. Now, anything that you put into a Roth IRA, you can take out at any time, but if you want to access the growth potential or the growth and the gains in there as well, then you have to be 59 and a half or older without penalties or fees. So if that's the case, we see people where, they might be 50 years old and they run into a situation where they need a new roof or a new car or whatever the case might be, and they decide to dip into their retirement accounts, which is the last thing that we want to see you do. And they have to do that because they didn't take the time to build up their 3 months of living expenses in their savings. So again, if you can do that, if you can build up the 3 months of living expenses in your savings, that will allow you to not have to go into credit card debt and not have to tap into your investments early. And we want to see you build that up so that way you don't have to worry about that.
Okay, the last one we're going to talk about is the one that Tyler and I, of course, pay attention to an awful lot because we're investment advisors. We take care of investments, put together financial plans for our clients. And this one is not having enough for retirement. We see it a lot. Some people just do not have the ability to put the money away because of the income they've made, or they've gone through a divorce or fell on hard times. We understand that. But for those people who do have the ability, they make a good income. It seems to be they don't have enough set aside for retirement, but they have all the toys that you could possibly have. The other one we hear a lot is, I didn't put money into investments because I invested in my house. Well, that's good. I mean, it's an appreciable asset. We do understand that. But typically, the only time you get that money back out is when you sell your house. So now you're looking for something else, a different place to live. When you're putting that much money into a house, make sure you look around to see what the other houses in your neighborhood are selling for. If they're selling for an average of $225,000 to $250,000, and you put renovations and updates into your house and it's worth $400,000, you might have a hard time selling it. So when you say your investments are going into your house, remember that's an illiquid investment. That means it is helping your net worth. You're worth more with your house being worth more, but you can't just go to your house and pull out $50,000 unless there's a string attached to it. Okay, home equity line of credit or something like that, but you have to pay that back. So understand, we would like to see people put more into liquid positions, meaning investments, stocks, bonds, mutual funds, cash, CDs, annuities, whatever it may be, because that is going to be able to take care of your needs financially for the rest of your life in retirement. Tyler, what else am I missing here when we're talking about not saving enough above that 15% or below the 15%?
Yeah, so with the last money mistake of middle-income Americans, it'd be the not saving enough for retirement. And within that Primerica survey, they found that 1 in 4 Americans, so 25%, feel comfortable determining how much they need to save for retirement on their own. So 1 in 4 on their own feel comfortable trying to determine how much they need to save up. So that would be 75%, or 3 out of 4 really have no clue. And that tells me right there that what you need to do is you need to work with a professional and try and develop a plan that's going to make you feel much better. But a general rule of thumb, like I said before, is to work your way up to 15% of your income saved in various retirement accounts. So again, that's your 401k, 403b, 457, Roth accounts, whatever retirement accounts that you have access to. You want to work your way up to 15% of your income in those. But that's just a general rule of thumb. If you're older, or if you're planning on retiring early, or if you want to do a good amount of travel in retirement, then that might have to be adjusted one way or another. So again, it's always good to consult a professional and get a financial plan done, because if you do have a financial plan, that's going to allow you to set goals and then try and stay on track for those. Many people, they're just putting money in, a certain amount into their 401k, and they don't really know what the end game is. If they're putting a certain amount into their 401k at 45 years old and they want to retire at 60, they don't know if they should be putting in more, if the amount that they're putting in is good. They don't know if they have the right investments within their 401k for them. So again, it's always good to consult a professional, have a written plan. It's proven that when you do have a plan, you tend to stick to it and follow through with it, as opposed to those people that don't have a plan. We do financial plan for our clients. If you'd like one, give us a call, 920-347-9888, or check out our website. It's srsplans.com, where we'd be more than happy to take you through and give you a financial plan for yourself.
And as Tyler said, we do financial plans. Those are complimentary. Anybody who wants a complimentary financial plan, just let us know. Okay, that's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.